So the thing that I want to tell you first before we even start, 90% of traders fail, okay? And they fail not because of a lack of trying or because they're stupid or even because they're unlucky. It's because they don't know anything and they try to learn it with real money and they run out of money before they have a chance to learn how to trade. That's 90% of the traders that I know, including myself. I started in 2018 and I blew up my account. You know, I had a large, well, it was large for my standards, you know, and I blew it up. I blew it up. I even drew a line in the sand a couple of different times, you know, and I never had the discipline to respect that. And then thankfully, I'm very grateful now that I ran across the strat and I'm learning how to trade. But now I really did have to draw a line in the sand. The damage is done. I have psychological scarring from the amount of heavy losses that I took, um, and that messes you up. And that messes you up because psychologically, you need to be almost like a machine for this to work. You can't let your emotions play with you, and they will play with you. And that's the hardest thing to learn when it comes to trading. So you've got all these things that are against you from the start. Keep in mind, this is the market. You know, this thing is a beast. You have to respect it. You have to, it will rape you. It will take everything you own. So, so respect it. That doesn't mean you can't make money doing this. You just have to take the long road. You can't, there are no shortcuts. Okay. So one thing you need to do from the very beginning is you need to open a TD Ameritrade account. Doesn't have to be TD Ameritrade, but if you want to use any of my studies, it does, because these are written for TD Ameritrade. When you call them, you're going to call them and ask them for it to be a cash account, no margin. Okay. Too early for you to trade with margin anyways. You don't need that. And the cash account, there's this thing called the Pdt rule. It's the pattern day trader rule. It limits you to no more than 3 intraday round trips per 5 rolling day period. So you can only do 3 day trades in a 5 rolling day period. And if you go over that, they might give you a mulligan, but the next time that you'll get a suspension on your account. You won't be able to trade except for selling positions, and they just put all kinds of limitations. So because you don't even need to go that route yet, just stay with a cash account. You could trade as many times in and out during the day as you want, as long as you trade with settled funds. Usually funds with TD take a day or two to settle, about 2 days usually. Unless you trade options, which I don't recommend that you start doing yet. You need to know about common shares before we get into options. You know, options are cool because if you have a cash account, they settle overnight. So your entire balance is available to trade overnight. If you do common stock, which you will, what I would recommend is when you day trade or whatever, don't use tiny size, tiny, okay? Try not to get into these real expensive names that move $40 a day, because you don't want to take a $40 loss, you know. And you're going to need to set up as you go. You're going to need to develop a set of rules that apply to you because of the way your personality is, and you're going to have to stick with those rules. You know, like one rule, for example, that I have is 2 losing trades in a row, and I take a walk because I don't want to go on tilt. You know, another rule that I have is no trades between like 11 and 2 because there's just nothing going on really good. Sometimes there is. I'm not going to say that, but for my style, I look away. Another rule that I have is cut loss immediately. And we'll talk about all of the dynamics of trading psychology and everything. But you develop these rules. You can set a max daily loss. You can call your broker and tell them, turn me off if I hit this amount loss, and they won't let you trade anymore. Anything to protect your capital. That's the most important thing. Those are your soldiers. You're sending them to war. You don't want them to die. You want them to bring back prisoners for you, right? So only trade with a paper account, and only trade if you're going to do live, because you do want to do live to get your emotions involved, because you want to see how you react. But you don't want to add a whole bunch of sides where you're going to get all emotional about it. You're not going to even think straight. It really does mess with your mind, which is why it's fun. A lot of people say it's not even about the money, it's about the action, and that's what I like about it. That's what I enjoy about it. And the fact that you can make money on it, that's even more fantastic, right? So be responsible, and of course, disclaimer: you're responsible for your own trading decisions. I'm not for whatever you decide to do with your money. I'm not a financial advisor. This is not financial advice. This is for educational and for entertainment purposes only. You know, the disclaimers. So let's get to it. So the first thing I want to show you, let's go ahead and is just a bare knuckles chart, right? Now there's different types of charts. They got line charts, they got these little bar charts. When you go to Thinkorswim, when you open your Thinkorswim account for the first time, it's going to look probably something like this. And then you go down up here to charts, and you can customize your chart and whatnot. Don't get too freaked out with that. And one of the things that you can do is you choose what type of chart you're going to want to use, okay? So let me find that to your general appearance, okay? We want a candlesticks, okay? There's all kinds. There's bars, there's Heikin-Ashi candles, we're with the strat, we stick to candles. There's lines, you see lines pretty popular with certain apps, but we stick to candles. And so every candle has 4 parts that you need to be aware of, okay? A high, a low, an open, and a close. If the candle is red, it opens at the top of the body. If the candle is and it closes at the bottom of the body, okay? If the candle is green, it opened at the bottom of the body and closed at the top of the body, okay? And so we know if price is moving down because it's below the open or above the open. That's one of the ways that we can tell whether price is moving down or if it's moving up. And each chart that you load has a time frame. For example, this chart here is a 5-minute chart. That means that each one of these candles represents a period of 5 minutes. After every 5-minute period goes by, a new candle appears. These charts have settings that go from 1-minute candles. And this is, for example, this was today. That was the trading day today, okay, on the 1-minute chart. And you can pick them all the way up, sequentially, 5 minutes, 15, 30 minutes. You can select specific time frames. It's all customizable. In the strat, we use specific time frames to make our decisions and to see what's happening. We use the 5-minute, the 15-minute, the 30-minute, the 60-minute, the daily, the weekly, the monthly. Some people use the quarterly and even the yearly. And I'll talk about how we use each one of those time frames in a minute. But first, I want to go back to these individual candles. So we know that price can only do 3 things. It can either go up, or it can go down, or it can go sideways, right? Those are the only 3 options, right? And so, for example, I'm probably not going to find one, but if I passed one right there. See how that one's white, and the open and the close are the exact same place? Price didn't change during that 1 minute. It tested, it tried to go a little higher, came back, tried to go a little lower, came back. It just, during that period of time, there was no real direction. It just went sideways. Okay. Another thing that happens is these bars, when you compare them to one another, show this relative movement. And I say relative because price doesn't actually move. It's not this thing that exists in the physical world that can go from one place to another. Price aggregates. And I say that because if you looked at this entire period of time on a higher time frame, it could be anything from 1 or 2 candles to 1 candle. For example, this whole chart right here is 1 candle on a daily chart. That's this candle. That was yesterday. So you see how as we zoom in, as we start to zoom in, we start to see how Each one of these candles has a world of its own on the inside, right? Because there's a whole period of time on the inside where price is doing all kinds of stuff. And ultimately, what we know on each time frame is for that particular period of time at that particular moment, where it opened, where it hit a high, where it hit a low, and where it closed, right? Or in this case here, it opened here, and it closed here, because it's a green bar. And you hit the nail on the head with the word range, because what we're interested in here is range and position. Okay, so we can't compare this bar to the next bar because it hasn't happened yet, right? We don't know what's going to happen in the future. And when it comes to trading, you never know, but we can try to stack the odds in our favor by increasing the probabilities that we will be right if we know how price action behaves, if we know how to read price action, if we understand the process of price discovery, you know, and if we can do a proper time frame analysis, then we increase the odds over time that we can make the right decisions, right? And then of course we have to have the discipline to cut the trade if we make the wrong decision. Okay. But anyways, I digress. The point is we can't compare this to the future. We can only compare it to the past, right? So every candle, every bar you look at, compared to the previous bar, is going to be only one of three scenarios. And I'm sorry about the barking. It's just that my wife just got home. And the dog is gonna keep barking until my wife walks through the door and says hello. Sorry about that. But anyways, so when we compare a candle to a previous candle, there's only one of three possible scenarios, and that's what they're called. That's what Rob calls them. This is all based on Rob Smith's The Strat. Should have said that from the beginning, but I knew you understand. You knew that. But anyways, so I developed a study that will automatically number them based on what scenario they are, and you can see that there are only three possible scenarios. A1 is this scenario right here, where this period of time, this bar, this day, traded entirely within the previous day's range. It did not take out the previous day's high, and it did not take out the previous day's low. Okay, so the low, today's low, is higher than yesterday's low, and today's high is higher than yesterday's high. We good so far? Okay. And this is a period of time that represents equilibrium. Okay. It's when the buyers and sellers are struggling for control. Price is not really moving in any direction. Price is moving sideways, relatively speaking. In this case, during this day, it closed green. It did close higher, but it didn't take out any part of the previous range. So for the most part, we consider this to be a balance or an equilibrium, where neither the sellers nor the buyers are really in control. Okay. The second scenario is a scenario number 2, which is what you see here. And there are two options for a 2. A 2 can either be a 2 down or a 2 up. This is a 2 down. In a 2 down, the low took out the previous day's low, but the high did not take out the previous day's high. This is a directional candle. When we see 2s, price is going up or down. Okay. Again, price doesn't move, it aggregates. Remember, all of this is happening inside of a different time frame. So it's aggregating in that time frame, but it's getting higher or lower based on the fact that it took out a previous low and not a previous high. Okay. The other kind of 2 is a 2 up. And here's a good example. In this case, we see a 2 up because it took out the high of the previous candle and it didn't take out the low. So this is a 2 up and a 2 down. Both of these are directional. In this case, the buyers are in control. In this case, the sellers are in control. In these bars, nobody's in control. And you see how the range keeps getting tighter? You have a day inside of a day's range. Range just keeps getting smaller and smaller and smaller, right? You'll see that sometimes. This is good. We like this. I'll tell you why later. But in any case, right now I want you to notice though that even though this is a 2 up because it actually took out the entire day's range to the upside. You see that? It gapped up. Now, what do we know about red bars? They open at the top of the body and close at the bottom of the body, which means that this day actually opened up here. Tried to go even a little higher. There was buyer exhaustion, just run out of buyers. Started coming in on itself and started collapsing on itself once it went red for the day, all the way down, trying to close the gap because it gapped up. That's called a gap up. And this type of play in this type of stock is what we call a gap and crap. Gapped, crapped. Okay. So this isn't, do we want to know about this? Yes. Do we want to know if there's a 2 up and that keeps going up? Hell yes. Do we want to know if there's a 2 up that collapses in on itself? Yes, because what we see is happening here is a change in continuity, meaning this bar is green and this one's red. So there's conflict. It's going back in to previous range, which it never actually traveled in this case because it gapped up, but it's closing the gap. It's going in conflict. It's not continuing up. It's going against continuity. Okay. Now that's a very simple explanation for why you see a 2 up that could be red. And there's a lot more to it than that. But just know that it doesn't matter that it's red. It's still a 2 up for scenario purposes, for the strat purposes. But it does matter that it's red in the sense that price has collapsed below the open. You see, there's these things we know that are called universal truths. This all started when Rob got sick of like the technical indicators and oscillators and everything that is patterns and all of that that is subjective and that is lagging and doesn't really tell the truth. And so he was like, well, what do we know to be true about price action? And we know that these are truths that are completely irrefutable. If once the period is closed, the range has been established. We know where it opened. We know where it closed. We know where the high was. We know where the low was. You can't change that anymore. And even as it's forming, for example, let's say right here, this candle's still forming. Okay, this is a 2 down. It already took out this previous range. It could go back up and become a 3, which is one that I haven't talked to you about. A 3 in this case took out the high and took out the low of the previous range. So this is what Rob calls a broadening formation because range is expanding, right? So because it took out the high and it took out the low, we know that they were willing to buy it up and sell it down past the previous range. So this is a period of volatility and range expansion. Range is simply how far did it travel within a period of time. These have very little range. These long red and green bars, they have a lot of range. And if you're on the right side of the trade during one of these long green bars, then you stand to make a lot of money because continuity is in your favor and there's range. you know there's range. If you can't make a lot of money in this unless you go with a very large position, which involves a lot of risk. But here, when you've got a lot of range like this and price is moving, remember this is an entire day's action right here from 80.20 to 147.98. I mean, look, just think about 100 shares would have cost you $800. You would have had $15,000 payout in one day. This is actually the perfect example to talk about range and volatility because this has more volatility. Now, that means there was going to be moments in there where it was going to do these big moves to the downside too that were going to shake you out, you know. But in general, we look for these types of candles on a higher time frame, and then we want to trade inside of them, like on the lower time frames. So far, do you have any questions about any of this? So we see a lot of range on the 2s. The 1s couldn't have range. This was a 1. This was entirely inside the previous day's range. And look at the range. It was not as big as the previous day, but it did have quite a bit of range. But compared to the previous day, price was in relative equilibrium. And then what happens when that equilibrium is broken? Then there's tend to be some large moves if there's a lot of volatility. Rob describes it like a top that seems to be motionless as it spins. And if you go and poke it, it's going to shoot out in one direction because it's got all this energy in it, and it's just standing there in equilibrium. Anything that disturbs that is going to cause a big move. And so this technically is equilibrium in the sense that it's all inside of the previous range. It didn't move up or down from the previous day, but it had a lot of volatility in it. And once that equilibrium was broken, that's when you see a move that goes ultimately from 147 to $483, right? So that's the importance of range expansion, volatility, range contraction. Okay, so threes take out both sides of the previous range. Range expansion. Ones doesn't take out either side of the previous range. Range contraction. All right. Now, when range expansion happens, we see that on a high time frame like this, on the daily, we see that as a high to a higher high and a low to a lower low, which is the definition of a broadening formation. So there is a high to a higher high and a low to a lower low. Now, on a lower time frame, you're not going to see two bars, but you are going to see a broadening formation. So let's go to the 1 hour. There we go. So, and in this case, for example, I drew it on the using the daily candle, so it didn't exactly snap to my highs and lows. So I'm going to go ahead and put that. I'm going to change that. Now that I know where it went there, and it went really. If we're looking at the pre-market from there to there, okay. So that's a broadening formation. So as I'm looking at any chart, I'm always keeping an eye out for any time I see a high going to a higher high and a low going to a lower low. Anytime that happens, then I start to think we're in a broadening formation. Okay. Now, according to Rob, broadening formations represent not just a period of volatility expansion, but it's the beginning of price discovery. And price discovery moves along a series of broadening formations. So let's go over here, for example, to the last time we had a 3. Let's see here. Whoop. Sorry. Bear with me. Let's look at on the daily. The last time we had a 3 right there. So we had a broadening formation. Let's go ahead and draw that out. And actually, I wrote a script that'll find them. It's called Broadening Formations, and automatically draw them for me. So you'll kind of see what I'm talking about. You see what I'm talking about? Now, because there's a broadening formation doesn't mean that price has to reverse and go back to the bottom of the triangle, because this forms a triangle. You see that? Every one of these is a triangle. That doesn't mean we have to go back to the bottom of the triangle. That just means that price is broadening and expanding, and that's exactly what continued to happen here with each one of these broadening formations. Okay, and if we zoom and if we draw over them, for example, if we just look at the one for today, which is what I do, I go and when I do my time frame analysis, I go and draw broadening formations starting on the higher time frame to the lower time frames, and I draw the most recent ones. So, for example, if we were starting here with the daily, we can draw this broadening formation from here to here. I draw over it because once I go to a lower time frame, it's going to disappear. This script only puts it on the higher time frame. It puts it on the time frame where it sees an outside bar, right? But if we go in and look at 15-minute, you can get a feel. Let me go ahead and delete. Well, you see how a lot of these broadening formations work out on their own. Let me delete them because it starts to get a little noisy, but you can see how it set up that range and then it moved along, the top of the triangle. Now, and then after that, it developed this consolidation period right here. Okay. that we're breaking out of. On a higher time frame, all of this is inside of something else. Okay, so we know that price moves, along a series of broadening formations. All right. But also sometimes the range expands and contracts and we get stuck inside a previous range. And as long as we're inside that previous range, like all of this here, we're not moving until we can break out. Where was the breakout here, for example? The breakout was right there. And you see, once it did break out, it actually broke out rather well. So we're always looking for a breakout of highs, a breakout of lows. Where's a higher high, lower low, right? But when we draw the broadening formations, it specifically goes from a high to a higher high and a low to a lower low. Okay. If we go, for example, we draw this broadening formation right here. And actually, let me redraw that line. Sometimes price likes to go back and sort of revisit where it's been. Right there. So we went from the high to a higher high, low to a lower low. And in this case, the lower low wasn't made immediately. It wasn't. Let's zoom in on this real quick. For example, if we really wanted to do the broadening formation based off of that one candle only, then yeah, we could go low to like a low low, right? And it kind of played around with that level a little bit, but ultimately it broke it, made the low of the triangle, right, that was in force, and then reversed and went up, and where did it go? The top of the triangle. See, like right here, we kind of reversed off of it a little bit, but then it eventually went up to the top of the triangle. That's what you need to know about broadening formations, is that it's a 3 here, for example. This is a 3 of this stuff here because it's outside of all of this, right? Even though it's actually 1, 3, this is still expanding the range a little bit here, right? All of this here is a 3 of all of this because all of this is outside of all of this. So if I were to draw, for example, hold on. If I were to draw one here, and pretend that that's a candle right there, then all of this here is inside, okay, of that range. So when we break that to the upside, it can, it does what's called an actionable signal because we have reason to believe that an equilibrium is broken and buyers or sellers are in control. Okay. In this case, when we see this range expansion, Rob always says if they're willing to buy it up and sell it down, they might be willing to do it again, to buy it up and sell it down again. And we see that happens a lot, actually. And so we're always aware of where we are on the broadening formations in every time frame, in any and every time frame. And we're always aware that we can always reverse off the top of a triangle and then go and revisit the bottom of a triangle. That happens all the time. Like let's say, for example, I don't know. Let's look at something different. Let's do the ES. Okay, we're back on GME. Let's look at GME. Same thing. This is GameStop. Let's look at how some of that played out. This just doesn't. It's not the best example, but let's look at it on the 1 minute, and you'll see what I'm talking about. Look at that. See what I mean? So they were willing to buy it up and sell it down, and they did it again. And every time it goes off of the top of the triangle, we want to know about that because we might go to the bottom of the triangle, or we might go down a little way and then come back up, or there might be a new triangle like what happened here, where there's top, there was a higher high, lower low, kind of messed around a little bit, broke out of that level. This is a triangle too, right here. Remember, because this was a low to a lower low on that one time frame where it was one candle and another that made part of a triangle. And once it finally did broke up out of there, there was some reversal, there was some consolidation. You see some range tightening here. It's kind of obliterated by all the numbers, but once that broke, boom. Where are we going? Top of the tri. See that? Top of the tri. And it works out like that a lot, a lot. So that's how we know that price moves along a series of broadening formations. And that's why we know that by nature a 3 expands the previous range, right? But we don't want to get stuck inside of that mother bar situation because um, each one of these bars, you know, um, has that high or the low, and it can't keep going up or down. It can't continue until it goes above that high or low, you know. So that takes me to let's take a break real quick here and see. Do you have any questions so far of anything, any of the stuff that I've gone over? Oh, that's right. It has a number of scripts that are already in it. And I mean, like, you'll never get to the bottom of this list. Each one of these is developed by somebody who traded, who, you know, like the Darvis box. You know, read about this guy named Darvis. It's actually very similar to what we're doing here. And so there's these technical indicators and these tools that have been developed to use with those systems. So if you use one of these indicators, no matter what indicator you use, be sure to know the history of it. Be sure to know what it actually does show you. Don't just go by what people say. Like, do some research on it before you learn it. But what we love about the strat is we don't need to use indicators. We have been freed of indicators. We use price action. The only studies that I have work based on price action. An indicator like what I'm talking about is, for example, there's these things called technical indicators, like RSI is a big one. It's called the relative strength indicator. Okay, you slap that onto a chart, and it's giving you this oscillating line right here. And ostensibly, when it crosses above a certain level, the stock is very strong. When it crosses below a certain level, the stock is very weak. And sometimes people use these crossovers to decide to buy. Like, that would have been a good buy right there. See, um, only because of the price action, though, because we were reversing off the bottom of the try, and then there was an inside and an inside bar, some consolidation, and it breaks. Buyers took control, and as a result of this, as a result of this, the RSI indicated upwards. Okay, that's why I don't use this, because they lag, and they move around. It'll look like it points up and then it'll point down on you. So I don't even mess with these. But if you want to, you need to know that they're there. People use them. These are really good for trading like range bound action. Um, I use a combination of these for trading range bound action, or at least I used to. I don't really anymore, because I really only just do script strat now. But when the action doesn't really move up or down, and it stays within that range. A lot of people use these to know when to buy and sell, like right there, sell, and then right there at the bottom, buy. And in general, it kind of works out, but I feel like my experience doing that has always been kind of a crapshoot. And that's why I like the strat. I mean, it's based on things that are true, not things that look a certain way. And actually, that's actually the best explanation I ever came up with for why I don't use these indicators. And here's another thing, is that if you don't understand it, you use it all wrong. Like, for example, this is relative strength indicator, but people say that, you'll hear people say this all the time about the RSI. Oh, it got into overbought. It's overbought. It needs to reverse. No, it doesn't. This means it has strength. It doesn't have to reverse. Once it gets up here where it's got strength, it's strong. It can keep going. Yeah. And once it gets down into where it's tanking and it's really weak, it's weak. It could keep going down. It could stay down here forever. They could just stay down there forever. Take any stock my computer's really slow, so I don't want to pull up another chart. But any stock that's tanking, you'll just see this kind of wallow down here like this. Like this stock here is kind of strong, right? So what happens? It goes up and it just kind of stays up here. And if you were expecting to go short because you touched that line, well, big surprise, you're covering over here for a loss, right? Oh, which takes me to another thing. So there's two directions the stock can go. And there are two ways that you can make money. Although there's many ways that you can make money, but just in general, you can make money when the stock goes up. That's where you buy it low and sell it high. That's called long. You go long a stock. That's all the kind of trading you're going to do at the beginning. Or you can short a stock, which is where you make money on the way down. Okay. To make money long, you have to buy the shares, buy a position to open, and sell it to close. To go short, you have to borrow the shares from your brokerage and sell them immediately at a higher price and buy them back at a lower price and return the shares to the brokerage for a fee, for a number of fees. They charge finder's fees. They charge interest on the margin. They charge borrowing fees. They charge, most of the time, the stocks you would want to short anyways don't have shares available to short, because all the hedge funds or all the big players, have they took all the available shorts. You got to have like 200 grand in your account for them to even look at you and say, for them to even consider you for shorting on the level that you would have to really make money, unless you play options, because with options you can play the short side and have there not be too much risk or controlled risk. Why do I say controlled risk? Because if I buy a share for $212 and immediately it goes down, if I don't sell that share, I will lose. If it goes to zero, if GameStop goes bankrupt, I'll lose 210 or whatever it was, $210. But that's all I'll lose. I'll just literally lose all my money that I put into it. But that's it. But when I borrowed those shares here, let's say that I borrowed 100 shares of GameStop, okay? I don't owe them $22,786. I owe them 100 shares of GameStop. You dig? So there's a limit to how low a stock can go. It can go to zero. You can lose everything. But there is no limit to how high it can go. And on a day like that day, where the one I showed you, where it goes from $80 to $147, imagine that in reverse. You had shorted $800 worth, and now you owe the broker $14,000 because you never covered, and it kept going up. And then the next day it went to $400. Can you see the problem with shorting? It is literally unlimited risk, and it is the kind of risk that tends to happen because growth stocks tend to move up, don't they? Unless they're just turds, and sometimes stocks are turds, and that's why people short turds, because they fail, they move down. But as long as you're comfortable with unlimited risk, feel free to short. I personally don't feel like I'm at that point yet, and I'm probably never going to be there, or maybe I will. But I don't short. The only time I play a short side is when I play options. And I would recommend that you do the same as far as shorting. So let's see. So now we've gotten as far as the reversals. We've gotten as far as the scenarios. We haven't talked about reversals. So because there's a limited number of scenarios, right? Technically 6, because every number could opens and closes in a different places. So it actually could be a 2 up, 2 down, red or green, 1 up, 1 down, right? Red or green. But really 3 scenarios, the way I described. There's a limited number of ways that price can reverse. Okay. So one of them you see right here is a 2, 1, 2 reversal. So here we had a 2 down, a 1, and a 2 up. Okay. Another kind of reversal, just remember that. That's something you're going to have to memorize. 2, 1, 2. Okay. 2, 1, 2. Just because I say reversal, doesn't mean a change in the direction of the stock. It just means price is going one way, and then for a period of time it goes the other way, right? Like, for example, let me find a reversal that then goes the other way. Well, here, 2, 1, 2 reversal up. Now that 2 up is red, so we're already suspicious about that, and it didn't take out this, And then it did 2 up and then it went down. So this reversal, did it change the direction of the stock? No. But for this little moment in time, price reversed. That's what I mean by reversal. Okay. Some reversals actually do change the direction of the stock. Some reversals just wiggle it a little bit. Most of these are just wiggling it. This one here, this was a 2, 1, failed 2. It tried to go 2 up. It did go 2 up, but then it collapsed and went 3. It took out the previous range and then some. This is another type of reversal called a 2 goes 3. It was 2 up. It came back, went below its open, and then went 3. Anytime you see on any time frame a stock like here, remember it opens here. If it goes higher, now that's a 2 up, right? It can't be a 1 anymore, but it can still be a 3. And the way that it goes to be a 3 is it turns back around and reverses, goes under its open, goes red for that time period, and then takes out the low. And now we have volatility, expansion, broadening formation, all of that stuff I told you before. A 1 bar reversal to the downside. Okay, so a 2-1-2 takes 3 bars to happen. A 3 takes 1 bar to happen. Okay, that's the second kind of reversal. 2-1-2, or a 2 goes 3. Okay. The next type of reversal is a 2-2 reversal. 2 up, took out the high, not the low. 2 up, took out the high, not the low. And then 2 down, took out the low and not the high. Right here, 2, 2. Okay, so we have 2-1-2. 2 goes 3, and 2, 2. A 2-2 reversal. 2, 2. You dig? Okay, here's another one. 2, 1, 2, 2, 2. Reversed, reversed. It reversed, it reversed. Okay? So a reversal is not a pivot, but a pivot happens at a reversal. A pivot is a change in direction. See, came here, pivoted, and went the other way, right? That's a pivot. These are reversals. This one is a pivot. This one is not. Okay. This one is, that made a pivot. See, these are pivots. Okay. Price is pivoting. Look at this too right here. Look. This is not technically part of the strat because Rob doesn't teach it, but I'm noticing it, and I'm going to talk about it. This is what I'm calling a narrowing formation. Remember what I told you earlier about mother bar problems? All this action is mother bar problems, right? If you were in here and you were waiting to go above this or below this, either because you wanted to go long or short, you were going to be extremely frustrated this whole time. But what we notice about this is that, first of all, that an initial range was pretty large, right? And the range just keeps getting smaller and smaller and smaller, it just keeps contracting. That's why I call this a narrowing formation, right? And it's not until we actually break out of that range that it actually means something. And then it could break out and fake out like this did. Right here, where it broke out and faked out and then came back in, right? But until it really goes outside of this range, we are still having all kinds of mother bar problems. Look, as I'm looking at price action, I'm still always looking for those broadening formations. Look, here's one right here. Now, I'm interested in all of them, but primarily I want to know what's happening on the most recent ones, right? There's one. And so you just draw them and you just observe that this is a phenomenon. This is not a pattern. Like you'll hear people talk about a head and shoulders pattern or this pattern or that pattern. Look at this. Where did we go? We bounced off of these. Where are we going? To back up to the top of the try. See that? That's why I Rob says price moves in a series of broadening formations, right? Let me remove these drawings real quick. Let me think. Okay, so we've got the 2-1-2, the 2-2 reversal, the 2 goes 3. There's another kind of reversal. I'll leave those on there for a minute so I can see there's better chances of finding one. A 3-1-2 reversal doesn't always have to be, but usually happens at a high or a low. That doesn't mean the high or the low, not the high or the low of the day, but just a high or a low in general. So a pivot, which is good. It's good to know because then that means that when we see 3-1-2, we can suspect, it doesn't always play out, but we can suspect that there will be a change in direction, at least momentarily, right? So let me see if I can find a 3-1-2. 1-2 here, 3-1-2 right there, 3-1-2 right there, 3-1-2. But and it did what I told you it would, pivoted. So that's a good example right there. Didn't have much room after that though. It was the end of the day, and we were, going this way. But at least for this brief moment, that was a bottom. That was a low, right? So it did a pivot there, right? Remember, they don't always happen at a pivot. These tend to happen at a pivot. Also, because they are threes, we know that there's some broadening formations. There's some volatility expansion. We can draw a BF right here, for example. Right there, and you can see that it did indeed. If we go down on the 1 minute, it looks even more interesting because it's like, what? Come over here. See that? And it was threes over here too. And it went and did a trip, made a high to a higher high. Then it made the second leg, lows to a lower low, back up to the top of the triangle, reversed off the top of the triangle, back to the bottom of the triangle, right? And how did it reverse? It did a 2-2 reversal. What they call what we call in the strat a Randy Jackson, because Randy Jackson from American Idol. He's like, that's gonna be a no for me, dog. When you see this type of indecision and you're like, you know what, I'm just getting out. I don't want to play that. There's a 2 up, 2 down, 2 up, 2 down, 2 down, 2, 2, 2, 2. Finally, it does a 3 and continues, right? All of that to reverse, but that's because this is a 1 minute chart. When you look at this on a 5 minute chart, you see a lot clearer reversal. Like this 3, 2, 2 goes 3 reversal. See that? It did barely took out that top of that high right there, and then reversed and went down. So that's a 2 goes 3 reversal off the bottom of the triangle. 3-1-2 off the bottom of the triangle. Okay. And a 3-2, 3 goes 2. Okay, so we've got the basic reversals. I even talked to you a little bit about a Randy Jackson. There's this thing called a Rev Strat. A Rev Strat is boy, that's probably going to be even harder to find. Is where there's a 1 and the next bar is a 3. So there was this period of equilibrium, and I did see one like that. Here we go. This is a Rev Strat. So there's this 1 period, right here, and it broke in one direction, and then it broke in the other direction. Okay. The Rev Strat is significant because, like I told you before, first of all, it's volatility expansion. It's a broadening formation, the beginning of price discovery. They're willing to buy it up and sell it down, but also neither the sellers or the buyers are really in control, but they're fighting out. They're duking it out. Do you want to get really caught in the middle of that? No, right? Because we saw already the beginning of these broadening formations tend to have reduced range compared to later on in the formation, right? So when you're trying to trade this here, you get chopped up a lot. If you're counting on price moving up and continuing to move up, it's better to go somewhere along the range where there's more range. If you're going to go back through previous range, it's always better to have more previous range. like this. How much range was there? How much range was there? All the fun we had no effect on our ability to trade better. How much range was there? Came up off of this, and then look at that. Where did we know about the range? Did we know about it here? No, we knew here, didn't we? Because we drew these lows to lower lows. When we were here and we hadn't seen any of this crap, and we see this broadening formation, and we see this price reverse 3, 2, 2, so 2, 2 fails and goes 3, even though it collapsed back in and then went against continuity, it went in conflict. The next bar that was in full time frame continuity that broke the high and continued to expand the range. Look at the size of that sucker, you know? And did we know at this point where we were going? Yeah, kind of, because we established there was a broadening formation and the range is expanding. And as long as we keep moving up along the broadening formation, we'll keep going up. And when we detach off of that and we start to reverse, we go through this little period of consolidation, some more broadening formations that we bounce off of. 3, 2, 2, so 2, 2 down to there, the bottom of the broadening formation. You dig? That's why price moves along a series of broadening formations. Okay. Yeah. There are none. This stuff is really new. This is why I'm really digging it. Some people don't even believe this is true. I'm like, how could it be not true? It's based on truth. Everything else is not based on truth. This is based on truth. I'm about to show you how true it is. Look, check this out. So we've been zooming in and out of this chart. I have no idea right now what the rest of this chart looks like, but I can tell you that at some point we're going to see this broadening formation play itself out as well. High, higher high. Come on. Oh, come on now. Switch pointers on me. Low, lower low. Let's see how that plays out. Still going up along the top of the broadening formation. Still going up along the top of the broadening formation. Where are we going to go if we reverse? Where do we go? If we go back, if we start going back up, do we go all the way up here? Probably not. I think that's the end of that, right? But we probably do go along one of these other broadening formations, like that one, right? And that one. So that's why we continually draw them high to higher high, low to lower low. And sometimes something happens where there's a pivot lower than what we had previously drawn our broadening formation. And when that happens, and we have established a pivot, we can redraw it, or we can draw another leg, the lower leg, like you saw me do. Real quick before I let you go, I'm gonna do an example of how I do broadening formation analysis from the higher time frames to the lower time frames, and then we'll call it a night. So we're gonna start with the yearly. It's not gonna have anything on it. Maybe. Well, there's kind of one. Okay. Go over here. Not really. Remember, each one of these candles is a year. So it could be a broadening formation. If we go from that low, yep, sure enough. Right to there. And from technically from here to there, but we're way outside of it. So the one that we are really more interested in is more like from here to like up there, right? And you can see we broke out of it. Oh, when you break out of these, sometimes it'll test it. It'll come back and test it, and that's support. It becomes support, and if it bumps against it and can't break out, it's resistance. Okay, we'll talk about that more later, but that's a different thing. And we go to the year. Let's zoom into the month. Definitely a broadening formation on the monthly. You can see it right there. Okay, definitely a broadening formation on the monthly. And what I mean by a different leg is you can see that leg right there too. So we're hopefully never going to get into that kind of action, but it might happen. And so I'll put that there. Let's go in, and you can see we're outside of this broadening formation, right? On the monthly, we're outside of the broadening formation. This is going to support us, hopefully. We hope. This is SPY, so this is based on the S&P. Then we go in quarterly. Do we see anything other, anything besides what we've already seen on the monthly? Not really. It's pretty much the same stuff. Let's go into the. I'm sorry, we did quarterlies before, and then we go into the weekly. You see how it's the same broadening formation, right? It's just there's more candles in there. Let me give my computer here a minute to. Okay, let me try to zoom into this. Okay, are we seeing a broadening formation on the weekly? And if so, where? Yeah, I mean, there's this one here, right? It goes like that. There's that one there. And then there's this one here. And how about here? A high to a higher high, low to a lower low. Sure. Right over here. A high to a higher high. A low to a lower low. Right? There's that 3 bar. Outside of that, I don't really see anything lower as far as a lower low. Now this looks like the top of a broadening formation, doesn't it? Look right here. Sure does, right? High to a higher high, and it's going along that, right? But we haven't made. We've got the first leg. Where's the first leg? We haven't made it yet. So if we go down here, boom, 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 we break down past all this, right? And we bounce off of. Let's say we bounce off of this here, which God forbid, right? Like, because that puts us over here, right? But if we bounce off of here, now we have leg 2 for a broadening formation that actually started over here, right? That's how that works. Okay, let's pull that. Let's pull it in again on the daily. Okay, what do we see as far as broadening formations? What's the most recent broadening formation on the daily? I am seeing. There's one here. There's one there, right? Okay. Let's go into the hourly. There's the hourly. Where's the most recent broadening formation on the hourly? Okay, on the hourly, definitely. Like high to a higher high that you'd be a fool to ignore right there. Right? Actually, you know what? I want to do this very precisely because I love watching how these lines intersect price action. Hold on. We said this one right there to right there. All right, let's zoom in here. See what happened. Okay, it touched them. Yeah, there it is. So that's the top of the try right there. That's the top of the try. And where is the bottom of the try? Where is a low to a lower low? I'm not seeing one. There's a low here, right? But we could say that's the top of the try, right? Where do we actually see one? Here. Let's delete that. I mean, it's relative. It's relevant because you can see it's affecting price action and it's high to a higher high. But really, if we want to find the low to a lower low in this broadening formation series, we actually have to go here, don't we? To there. Or no, here's one. Hold on, right here. There's one, right there. So let's draw that. Where's that? First place. We see this low to a lower low here to here, right? Right there. And high to a higher high from there to there. Whoop, come on now. From there to about there. Did we go there? Yeah. Top of the try, bottom of the try, top of the try. Trying to go back up, right? Okay, so that's like really the closest one I see. There could be one here too. This is a high to a higher high. This is a low to a lower low. So I might do like one or two. There's one or two, because this is what we're interested in here. What's happening here, and none of these are really playing out in this shorter time frame yet. So let's go into the 30. Yep. Any broadening formations? Not really. Let's go into the 15ers. Still no lower lows, just higher, just higher lows. And let's do the oneers. So here's where you do see them. Where do we see a low to a lower low and a high to a higher high? I'll bet you we do here at the beginning. Come on, man. There you go. How did that play out throughout the day? Well, we broke above it. See how it acts as support and resistance? Here, it's support. Are you still there? And now it's testing it as resistance and reversing off of it and consolidating. Like we said, look at all these ones and Randy Jacksons and Rev Strats and all this other crap here. All right. Now where are we going back up? And we do make another broadening formation here, right? So we had a did we? Kind of barely. If this is a broadening formation, that's the support. It's almost horizontal, right? Here's one. All right. Where else is there a broadening formation? Let's look here. There was one here. That we broke out of and tested and rejected. And that's it. And so we got all the way down to the 1 minute. And you can see how we do trade inside all of these other broadening formations that happen on these larger time frames, and these ones that happened previously affect what's happening in the future. And really, why I think the reason why we were consolidating up here so much is that we were on this higher time frame. That this line that right now looks like it's horizontal is a part of a broadening formation elsewhere. Remember, and this is called testing it. We're testing it now. It's probably here. This actually is probably here because we're testing it, but because it's on a higher time frame, it looks a little farther away. So I'll show you what I'm talking about by just coloring it a different color and showing to you once we zoom out. So that's where that broadening formation came from. That's where that line came from. It's acting as resistance right now for us since we had broken below that. You see? Look at this obvious broadening formation right here. Now you don't want this. You don't want your charts to look all cluttered either. That's why I say get the ones that are like the most recent ones, because those are the ones that are really going to affect. Look at that price action. Where did it go? To visit the bottom of the triangle again, where it made a bunch of other triangles and decided it's going to go up again. This is why we draw the triangles. This is why we need to be aware that this is happening on all the time frames. And when we plan our trades, we use these bars, these lines, sorry, to tell us where there's support and resistance, the top of the try and the bottom of the try and everything. Okay. All right. I think that was plenty, brother. If you have any questions, read that material I gave you. And if you have any questions, let me know and we'll talk about it the next time. Next time, we'll talk about actionable signals and time frame continuity. I'll try.